Welcome to this video series about measuring value creation in private equity, where we talk about incorporating add-on acquisitions and other holding period events into your value creation models. My name is Mike Reinhardt. I've worked in the industry for over 15 years. I wrote the book Private Equity Value Creation Analysis, and I run the AUXILIA, Mathematica, and ValueBridge.net websites. These videos are designed for private equity practitioners who use data to raise capital or evaluate the returns of private equity deals, funds, GPs, and investment programs. If you find this content helpful, consider subscribing and checking out the websites where you can download Microsoft Excel files for all these topics. This is video number 18 in the Value Creation series, where we cover holding period inflows and outflows. These are events that cause capital to go into a portfolio company after the initial acquisition, or cause capital to come out of a portfolio company prior to the ultimate exit. We need to adjust the value creation models for them, and there are many different types, including equity inflows, like follow-on equity investments used to acquire assets, growth or support investments, add-on acquisitions, investments from co-investors who might exercise a warrant, for example, and also contingent earnouts after the acquisition. There are debt inflows, which increase debt during the holding period. They include raising debt to acquire assets or finance new projects, growth debt like venture debt, debt used to fund add-on acquisitions or complete dividend recapitalizations, financing existing debt with new lenders, and other items like revolving lines of credit. There are equity outflows, including distributions from the company's balance sheet or the sale of assets like IP or PP&E, business unit divestments, dividend recapitalizations, and contingent earnouts after the exit. And finally, there are debt outflows, which reduce debt during a holding period. They include the regular principal payments that companies make during a holding period, large debt payoffs with cash on the balance sheet, proceeds from asset sales or business unit divestments, and again, refinancing existing debt with new lenders. While we're on the topic of adjustments, we can also mention those that come from the process of buying and selling companies. Transaction fees and expenses, working capital adjustments, cash added to the balance sheet at closing, cash left on the balance sheet by sellers, acquired liabilities like capital lease obligations, management and seller equity rollover, temporary seller debt financing, and cash holdback and escrow proceeds. Now, there's a lot here on this slide, but the adjustments are not difficult once you learn how to make them consistently. This video demonstrates 3 of them, with a company that first receives a support equity investment, then completes an add-on acquisition that is funded with both equity and debt, and then during the holding period makes an equity distribution to shareholders. You will be able to apply what you learn about the events in this video to make adjustments for all the other scenarios on this page. But if you want detailed instructions and examples for all of these situations, check out ValueBridge.net. It is a new website that covers everything we see here, with step-by-step instructions, short video demos, Microsoft Excel templates, and online calculators that tell you whether your own spreadsheets are giving you the right answers. It's a paint-by-numbers toolkit for private equity value creation models. As of November 2023, about 75% of ValueBridge.net content is already complete, and if you sign up before year-end, you can lock in a 50% discount on your subscription. Okay, now there are 2 ways to do the value creation math for these events. There is a one-step model on the top right that calculates all the different value drivers using a single value bridge. And there is a multi-step value creation model on the bottom left that calculates value creation between each of the events. So you have several value bridges, and total equity value creation for a value driver like EBITDA growth would be the sum of EBITDA growth in all the value bridges. You could probably already tell by comparing these 2 frames that the multi-step model requires a lot more data and a lot more work. It is a bit more accurate, but we'll see that the differences are typically minor. Ultimately, we will recommend the one-step model, but I think it helps to walk through this one first because it illustrates why the one-step math works. Here we have the company's entry metrics. It's a $100 million business with 50 of equity and 50 of net debt, so its equity and debt ratios are both 50%. We have EBITDA of 20, so its valuation multiple is 5.0, and revenue of 80, so its EBITDA margin is 25%. Note that here we're showing line items for total debt and cash. We don't typically do this because models only need net debt to work, but this helps to illustrate how some of the capital moves around in the different scenarios. We let some time go by, and by T2 the company's performance metrics are down a bit. Revenue drops to 76 and EBITDA drops to 18. Also, the prevailing market multiples are down, so the enterprise valuation drops to 86.4. On top of that, the company has burned through $5 million of cash, so net debt goes up to 55. This means that total equity drops to 31.4, and we have the following capital structure ratios. Given these changes, shareholders need to make a follow-on equity investment to support the business. But before we do that, let's go ahead and calculate what drove the equity losses to date. As you have seen from the other videos, we look at the metrics between T1 and T2, and then calculate differences, averages, and equity return multipliers. These are the numbers that we need to plug into the value creation equations. For example, revenue growth is the minus $4 million decrease times the average EBITDA margin multiple and equity ratio. EBITDA margin expansion is the minus 13% decrease times the average revenue multiple and equity ratio. Multiple expansion is the minus 0.2x decrease times the average EBITDA and equity ratio. Gearing is the $13.6 million drop in enterprise valuation times the average debt ratio. And cash flow generation is the cash burn of minus $5 million. As expected, these add up to the total equity loss of minus 18.6. What we'll do here is put all the value drivers in a table so we can track them for the various steps. Okay, next, the shareholders add $10 million of equity to the deal, so we increase total equity to 41.4. What many people don't realize is that we must think about where that equity goes. If it's used to buy an asset, like a piece of equipment or an intellectual property portfolio, it must immediately increase the enterprise valuation, like this. However, in this case, cash is added to the company's balance sheet, so cash goes up to 15, and because total debt doesn't change, net debt drops to 45. Note that this does not change the company's enterprise valuation, which is still at 86.4, but it does change the capital structure ratios because the additional equity unlevers the company. And also note that the support investment has no effect on these other metrics down here. Okay, how much value does a support equity investment like this create? The answer is none. We create zero value with such an investment. Yes, total equity went up by 10, but that's because we put 10 of equity in. Zero value creation. Yes, net debt went down by 10 because we put 10 of cash in the company's balance sheet. Zero value creation. In fact, none of these holding period events create value at the time that they're completed. That's because they just shift value around from one balance sheet to another or from one income statement to another. Value creation only occurs from organic changes, like from T1 to T2 and from immediately after the support investment at T2 prime until the next step, T3. Let's say that this company rebounds a bit. EBITDA and revenue return to 80 and 20. The valuation multiple goes up to 5.1, which makes the enterprise valuation 102. The company pays down 5 of debt and adds 3 of cash to the balance sheet, so net debt goes to 37. This takes total equity to 65 and provides the following capital structure ratios. Equity value creation from this step is 23.6, the difference between 41.4 and 65. And using the math that we showed before, it's made up of the following value drivers. All right, now let's do the add-on acquisition. We acquire a $20 million business, so we must immediately increase the enterprise valuation from 102 to 122 million. The deal contributes 18 of revenue and 5 of EBITDA, so right after the transaction, it makes the EBITDA margin 25.5% and the valuation multiple 4.88. We must account for how the deal was funded. In this case, that includes $8 million of equity from the shareholders, $8 million of new debt, and $4 million of cash from the company's balance sheet. This increases the company's net debt to 49 and provides the following capital structure ratios. So, how much value does the add-on acquisition create? Again, the answer is zero. Rearranging capital structure and income statement numbers creates no value, at least not initially. If it turns out that the add-on is extremely synergistic and allows you to sell the company for 10 times EBITDA instead of the 4.88 mark, then the add-on did help create value, but you see that as multiple expansion between T3 prime and exit. You do not see that in the transaction itself. In fact, if you really want to dial in on how much an add-on may have moved the valuation, you should really decouple your multiples from the broader market valuation trends and measure intrinsic multiple expansion as we described in video VC112 in this series. Alright, time has gone by again. At T4, revenue and EBITDA have increased to 102 and 27. The valuation multiple moves up a bit to provide an enterprise valuation of 137.2. Also, the company pays down 2 of debt and adds 6 of cash to the balance sheet, so net debt goes to 41. This takes total equity to 96.2 and provides the following capital structure ratios. Equity value creation from this step is 23.2, the difference between 73 and 96.2. And using the math that we showed before, it's made up of the following value drivers. Alright, being that we're sitting here with $20 million of cash on the company's balance sheet, let's go ahead and distribute that to shareholders. That will take equity down to 76.2, and because it comes from the balance sheet, it'll take cash down to 0. Since the equity distribution does not change total debt, net debt must increase from 41 to 61. Note that the swapping of debt and equity makes no change to the company's enterprise valuation, which remains at 137.2. But the distribution does represent a relevering, which changes the company's capital structure ratios. Like the follow-on equity investment we saw before, this equity distribution has no effect on the other value creation metrics. How much value does an equity distribution like this create? You guessed it, 0, for all the same reasons that we discussed before. Okay, now let's finally sell this company. By exit, which is at T5, revenue and EBITDA have increased to 108 and 30. The exit multiple is 5.18, so the exit valuation is 155.4. During the period, the company paid down 2 of debt and added 2 of cash to the balance sheet, so net debt went to 57. This takes total equity to 98.4 and provides the following capital structure ratios. Equity value creation for this final step is 22.2, the difference between 76.2 and 98.4. And using the math that we showed before, it's made up of the following value drivers. And that's it. We've done it. We've calculated value drivers for every step, and to get to the total, we just need to add across as follows. That provides revenue growth of 9.0, EBITDA margin expansion of 8.0, EBITDA multiple expansion of 6.6, gearing of 11.9, and cash flow generation of 15. That's great, but this analysis was a lot of work, and you probably can't get all the numbers that you need for it if you are not on the portfolio company's deal team. And even then, it might be a stretch. As analysts, what we usually have are these numbers at entry and exit. We should also know how much capital went into the deal and came out of the deal during the holding period like this, and we can usually find details about add-on acquisitions because GPs like to discuss these things in their reporting and marketing materials. But that is really it. We are unlikely to find these holding period capital structure and income statement metrics that tell us what companies look like immediately before or immediately after these transactions take place. So that makes this multi-step model approach impossible for many deals. Well, the good news is we'll see that the one-step value creation model gets us very close to these multi-step model results with much less data and much less work. This is what that model looks like, but first let's take a step back. We'll start with the metrics at entry and exit, and we won't show the total debt and total cash line items here because we don't need them. First, we will adjust the entry metrics for the inflows, like the follow-on equity investment and the add-on acquisition. And then we will adjust the exit metrics for the outflows like the equity distribution. This gives us a new value creation starting point called T1 prime and a new ending point called T5 prime. And from this, we can calculate all of the changes, averages, and multipliers. And when we plug them into the value creation equations, we will get value drivers that include the impact of the follow-on investment, of the add-on acquisition, and the equity distribution. Now, the type of holding period event dictates how each of these adjustments should be made. For a follow-on equity investment, the rules are add to Tech V1 any follow-on equity, subtract from ND1 any equity that goes to the company's balance sheet. So for the 10 million support investment, the adjustments are as follows. For add-on acquisitions, the rules are add to Tech V1 any equity funding, add to ND1 any debt funding, and also add any cash from the company's balance sheet that was used to fund the transaction. To the company's income statement, add the add-on's incremental TTM performance. So for the $20 million add-on in this example, these are the adjustments. For equity distributions, the rules are add to Tech V2 or Tech V5 any distributed equity and subtract from the net debt value any distributed equity that came from the company's balance sheet. For the $20 million equity distribution in this example, these are the adjustments. Now note that these rules only mention independent variables like total equity, net debt, revenue, and EBITDA. They do not mention enterprise valuations, capital structure ratios, or valuation multiples because those are dependent variables which come from the independent variables. All we need to do is add across the independent variables as follows, and then calculate the dependent variables within the T1 prime and T5 prime columns. Let us do a quick sanity check on these numbers. Total equity invested is 68 rather than 50 because we must account for the equity invested after the initial acquisition. Likewise, net debt is 52 instead of 50 because we count the 8 of extra debt in the add-on plus the 4 of cash used from the company's balance sheet in the add-on, but then we subtract the 10 of cash added to the balance sheet in the support equity investment. The starting enterprise valuation is 120, which is just the sum of the $100 million initial acquisition and the $20 million add-on. The starting revenue of 98 and EBITDA of 25 makes sure that we only get credit for organic performance improvements, not for the performance that we buy. And the slightly lower entry multiple accounts for the fact that the add-on, which has an EBITDA multiple of 4.0, lowers the original entry multiple from 5.0 to 4.8. On the exit side, adding the holding period distribution of 20 to the exit proceeds of 98.4 gives us the total equity return of 118.4, and subtracting that 20 from net debt makes sure that the company gets credit for the cash that it generated during the holding period. Since this all makes sense, we can go ahead and calculate the differences, averages, and multipliers and begin plugging them into our value creation formulas. Using the same math that we showed before, revenue growth comes out to 8.8, EBITDA margin expansion comes out to 7.7, EBITDA multiple expansion comes out to 6.9, gearing comes out to 11.9, and cash flow generation is 15.0. These do, in fact, add up to the total equity value creation of 50.4 from the difference between 68 of total invested equity and the total equity return of 118.4 million. So, how did we do? To check that, we can look at the multi-step and one-step models side by side. We see that they are nearly identical. The biggest difference in this case is within multiple expansion, and that's about 330,000. But in the context of a deal that created over 50 million of equity value, that's less than 1%. So this one-step value creation model is sufficiently accurate, and it's probably the only model that you're actually going to be able to perform given the data that you have available for most private equity deals. We highly recommend that you use it, but to do so you must be prepared to make adjustments for various holding period events. In this video, we covered follow-on equity investments, add-on acquisitions, and equity distributions. To figure out adjustments for other events, you can do what we did here. Start by thinking in terms of a multi-step value creation model context and consider how each inflow or outflow will affect a company's capital structure, balance sheet, and P&L. That'll indicate how you should make your adjustments. Or you might consider subscribing to valuebridge.net, where we show you exactly how to make these adjustments for all these scenarios. Thank you for watching. If you are interested in this sort of thing, please like, subscribe, and check out all the private equity value creation videos on AUXILIA Mathematica. Registration is free and gives you full access to downloadable Microsoft Excel templates, articles, white papers, online value creation calculators, and other content. And don't forget, you can also check out valuebridge.net if you want a paint-by-numbers guide to building these kind of models within a couple of hours. Thanks for watching. I hope to see you at AUXILIA Mathematica or valuebridge.net.